Welcome to a deep dive into one of the most legendary books on investing ever written, The Intelligent Investor by Benjamin Graham. If you've ever dreamed of growing your money, avoiding costly mistakes, or building a rock-solid financial future, this book is your blueprint. Published in 1949 and still relevant today, it's the Gospel of Value Investing, endorsed by none other than Warren Buffett, who calls it the best book on investing ever written. And trust me, we're going to unpack why that's true over the next few minutes. Here's the deal. I'm going to walk you through the heart of Graham's wisdom, share the top 10 biggest takeaways that can transform how you approach the stock market. And here's the kicker. I'm going to save the single most important tip for the very end. This one tip is the foundation of everything Graham teaches, and it's so powerful that it could change the way you invest forever. So, stick around, because you don't want to miss it. Ready? Let's dive in. Welcome to the Trade Savvy Academy, the foundation of the intelligent investor. Benjamin Graham wasn't just an investor. He was a revolutionary thinker who redefined what it means to invest smartly. A professor, mentor to Warren Buffett, and a Wall Street legend, Graham wrote The Intelligent Investor to teach everyday people how to navigate the wild, unpredictable world of the stock market. His core idea? Investing isn't about gambling or chasing hot stocks. It's about discipline, patience, and a mindset that prioritizes safety over speculation. Graham introduces two types of investors: the defensive investor, who wants safety and minimal effort, and the enterprising investor, who's willing to put in more work for higher returns. But whether you're cautious or ambitious, Graham's principles apply universally. His goal is to make you an intelligent investor, someone who thinks long-term, avoids emotional traps, and focuses on real value. Let's break down the top 10 takeaways that make this book a must-read. And along the way, I'll tease that game-changing tip you're waiting for. Takeaway number 1. Invest, don't speculate. First up, Graham draws a crystal-clear line between investing and speculating. Investing is about analyzing a company's fundamentals, its earnings, assets, and growth potential, and buying its stock at a price that makes sense. Speculating, on the other hand, is like rolling the dice, chasing trendy stocks, betting on rumors, or hoping for a quick payday. Graham warns that speculation is a loser's game. The stock market isn't a casino, and treating it like one is a recipe for disaster. Think about it. How many times have you heard about someone jumping on a hot stock only to lose their shirt when the hype fizzles? Graham's advice is to stick to companies with solid track records and buy them when they're undervalued. This leads us to one of his most famous concepts, which we'll get to in a bit. For now, know that being an intelligent investor means saying no to the get-rich-quick mentality. Takeaway number 2. The power of Mr. Market. One of Graham's most brilliant ideas is the allegory of Mr. Market. Imagine the stock market as a moody business partner named Mr. Market, who shows up every day offering to buy or sell your shares at wildly different prices. Some days, he's euphoric, offering sky-high prices for your stocks. Other days, he's depressed, practically giving them away. Here's the genius part. You don't have to deal with Mr. Market unless you want to. His prices are just noise unless you act on them. Graham's point is that stock prices fluctuate based on emotions, not logic. Instead of panicking when prices drop or getting greedy when they soar, focus on the underlying value of your investments. Mr. Market teaches us to stay calm, ignore short-term noise, and only act when the price is right. This mindset is a cornerstone of intelligent investing, and it's a hint toward that big tip I'll reveal later. Takeaway number 3. The margin of safety. Here's where things get juicy. Graham's concept of the margin of safety. This is the idea that you should only buy a stock when it's priced significantly below its intrinsic value, the true worth of the company based on its earnings, assets, and growth. The difference between the stock's price and its intrinsic value is your margin of safety, a buffer that protects you from mistakes, bad luck, or market crashes. Imagine buying a house worth $200,000 for only $150,000. Even if the market tanks, you're still in good shape because you bought at a discount. That's the margin of safety in action. Graham says this principle is the secret to minimizing risk while maximizing returns. It's not about predicting the future. It's about being prepared for the worst. Hold on to this idea because it ties directly into our big reveal at the end. If you're enjoying this video, please support my channel by liking, sharing, and subscribing. Takeaway number 4. Focus on intrinsic value. So how do you know if a stock is undervalued? That's where intrinsic value comes in. Graham teaches that every company has an underlying worth, calculated by analyzing its financials, things like earnings, dividends, debt, and growth prospects. Your job as an intelligent investor is to estimate this value and only buy when the stock's price is well below it. This sounds technical, but Graham makes it practical. He advises looking for companies with consistent earnings, low debt, and a history of paying dividends. These are signs of a business that's built to last. By focusing on intrinsic value, you're not swayed by market hype or fear. You're grounded in reality. This discipline is what separates the pros from the amateurs. Takeaway number 5. Diversification reduces risk. Graham is all about playing it smart, and that means diversifying your portfolio. Don't put all your eggs in one basket, no matter how great a company seems. By spreading your investments across different industries, company sizes, and even asset types like stocks and bonds, you reduce the risk of a single bad bet wiping you out. For defensive investors, Graham recommends a balanced portfolio, say 50% stocks and 50% bonds, to weather market storms. Enterprising investors might lean heavier into stocks but still diversify across sectors. The key is to avoid overconfidence. Even the best investors make mistakes, and diversification is your safety net. Takeaway number 6. Dividends matter. In Graham's world, dividends are a big deal. A company that pays consistent dividends is like a landlord who sends you rent checks every quarter. Dividends are proof that a company is profitable and committed to sharing its success with shareholders. Plus, they provide a steady income stream, which can be reinvested to compound your wealth over time. Graham advises looking for companies with a long history of paying and increasing dividends, as this signals financial strength. In volatile markets, dividends can also cushion the blow of falling stock prices. It's not the flashiest strategy, but it's a reliable way to build wealth steadily. Takeaway number 7. Don't follow the crowd. The stock market is a herd, and the herd is often wrong. Graham warns against getting swept up in market manias. Those moments when everyone's piling into a stock or sector because it's the next big thing. Remember the dot-com bubble or the crypto craze? Those are classic examples of herd mentality leading to disaster. Intelligent investors think independently. They do their homework, trust their analysis, and stick to their principles, even when the crowd is screaming to do the opposite. This contrarian mindset is tough but rewarding. As Graham puts it, the investor's chief problem, and even his worst enemy, is likely to be himself. Takeaway number 8. The importance of discipline. Speaking of self-control, Graham hammers home the need for emotional discipline. The stock market is an emotional roller coaster, with greed and fear driving prices to extremes. Intelligent investors stay cool-headed, sticking to their strategy no matter what the market throws at them. This means not selling in a panic when stocks crash or buying in a frenzy when prices soar. It also means having a clear investment plan, whether it's a set allocation between stocks and bonds or a list of criteria for buying stocks, and following it religiously. Discipline is what keeps you from becoming your own worst enemy. Takeaway number 9. Long-term thinking wins. Graham's philosophy is built on patience. The stock market isn't a sprint, it's a marathon. Intelligent investors focus on long-term growth, not short-term gains. By holding quality stocks for years, even decades, you let the power of compounding work its magic. This long-term mindset also helps you weather market downturns. Graham reminds us that bear markets are temporary, and over time, well-chosen investments tend to recover and grow. So, don't obsess over daily price swings. Keep your eyes on the horizon, and let time do the heavy lifting. Takeaway number 10. Bonds for balance. Finally, Graham emphasizes the role of bonds in a balanced portfolio, especially for defensive investors. Bonds are less exciting than stocks, but they provide stability and income. They're like the dependable friend who keeps you grounded when things get crazy. Graham suggests that defensive investors keep a significant portion of their portfolio in high-quality bonds, like U.S. Treasuries or investment-grade corporate bonds. Even enterprising investors should hold some bonds to reduce risk. The exact mix depends on your goals and risk tolerance, but bonds are a key tool for staying safe in an unpredictable market. Why the intelligent investor matters today. Before we get to that big tip, let's talk about why Graham's ideas are still so relevant. The stock market has changed a lot since 1949. Think high-frequency trading, ETFs, and meme stocks. But human nature hasn't. People still chase fads, panic in crashes, and overestimate their ability to beat the market. Graham's principles cut through the noise, offering timeless wisdom for navigating any market environment. Take Warren Buffett, Graham's most famous student. Buffett built his fortune by following Graham's playbook, buying undervalued companies, holding them for the long haul, and ignoring market hype. If it works for one of the richest people alive, it's worth paying attention to. But Graham's approach isn't just for billionaires, it's for anyone who wants to invest with confidence and avoid costly mistakes. The most important tip? Revealed. All right, you've stuck with me. And it's time for the big reveal. The single most important tip from the intelligent investor. Drumroll, please. It's the margin of safety. I know we touched on it earlier, but let me explain why this is the cornerstone of Graham's philosophy and the key to becoming a truly intelligent investor. The margin of safety is all about protecting yourself from the unknown. No matter how smart you are, you can't predict the future. Economic downturns, company scandals, or global crises can hit out of nowhere. By only buying stocks at a significant discount to their intrinsic value, you create a buffer that shields you from these risks. It's like wearing a seatbelt. You hope you never need it, but it's there to save you if things go wrong. Graham believed that the margin of safety is what separates investing from gambling. It's not about being right every time. It's about ensuring that even when you're wrong, you don't lose big. This principle forces you to be disciplined, to do your homework, and to resist the temptation to overpay for a stock just because it's popular. In a world obsessed with quick wins, the margin of safety is a reminder to play the long game and prioritize safety over greed. Now, let's recap the key lessons. Invest, don't speculate. Focus on fundamentals, not hype. Ignore Mr. Market's mood swings and stick to value. Always seek a margin of safety to protect your downside. Calculate intrinsic value to find undervalued stocks. Diversify to spread risk across your portfolio. Prioritize dividends for steady income and stability. Think independently and avoid the herd mentality. Stay disciplined, no matter how emotional the market gets. Think long-term to harness the power of compounding. Use bonds to balance risk and add stability. These principles aren't just theory, they're a roadmap to financial success. Whether you're a beginner saving for retirement or a seasoned investor looking to sharpen your strategy, Graham's wisdom can guide you. And the best part? You don't need to be a genius or have millions to start. All it takes is a commitment to learning, a focus on value, and the patience to let your investments grow. Your next steps. Before I let you go, here's a call to action. Pick up a copy of The Intelligent Investor and read it cover to cover. It's not always an easy read. Graham's style can be dense, but it's worth the effort. If you want a quicker start, check out the updated editions with commentary by Jason Zweig, which connect Graham's ideas to today's markets. You can also follow Graham's principles by researching undervalued stocks, building a diversified portfolio, and keeping the margin of safety front and center. And hey, if you found this video helpful, give it a thumbs up, share it with a friend, and subscribe for more insights on building wealth the smart way. Let me know in the comments. What's your biggest takeaway from The Intelligent Investor, or what investing topic do you want me to cover next? Thanks for watching, and I'll see you in the next one. Keep investing intelligently.